Hello students and welcome to Legacy IAS. In today's session, we'll be talking about the performance review of NBFCs. Now this performance review is basically through an RBI article, alright, and which has talked about the performance review of NBFCs under the scale-based regulation. Basically the idea is, since the RBI has brought in the scale-based regulation, the performance of NBFCs have improved. So we will see how the performance has been, we will see what is the scale-based regulation, at the same times we will understand what NBFCs are. So let's get started. So what's the news? The RBI has recently came up with an article titled Peeling the Layers. Why peeling the layers? Because they have come up with scale-based regulation system. So there are different layers of regulation. Peeling the layers, a review of the NBFC sector in recent times. Right. So this article has highlighted that NBFCs remain resilient. They have remained resilient. One key factor was that they have remained resilient post the introduction of scale-based regulation since 2022. So first things first, what are NBFCs? The full form of NBFCs is non-banking financial companies. So they are financial companies, but they are non-banking financial companies, which means they are similar to banks but not banks. Non-banking financial companies. So they are banks, similar to banks but not banks. Since they are companies, they are registered under the Companies Act. Remember that NBFCs, they are companies, so they are registered under the Companies Act. That means there will be dual regulation. What is that dual regulation? One is that they will follow the guidelines of the Companies Act. And the second thing is they will also be ultimately regulated by the RBI. So that is dual regulation would be present over here. Okay, now they are financial, non-banking but financial companies, so they will do certain financial activities. What are they? Business of loans and advances, acquisition of marketable securities like leasing, hire purchase, all those things, securities, insurance business, chit fund business, etc. So there would be different kinds of NBFCs in different sector. So we saw they are companies under the Companies Act but dual regulation, because there is regulation of RBI also. They are financial companies, so the financial activities they are doing, but they are non-banking. So certain things they will be doing which I would say rather certain things they cannot do which the banks can do, is what we will see here. What are those things? These are things like they cannot issue credit cards. Now at the same time, one more very important thing is they cannot issue checks drawn in their own name. For example, an ICICI bank can give you a check which is drawn in the name of ICICI bank only, but that is something which the NBFCs cannot do. I hope this is absolutely clear. Now coming on to what is this scale-based regulation which has been implemented since 2022 by the RBI. Understand this, that there are various NBFCs, right? Now various NBFCs will be at various stages of development, various stages of market capitalization of various sizes and shapes and sizes basically, right? So if we treat every NBFC with the same amount of regulation, there would be issue. Some NBFC which may require more liberty or which has proven itself to get more liberty is still restricted. That's a problem. Some NBFC needs more stricter regulation but more liberty is given because it's given to everyone. Then again a problem. So problem is in giving too much of liberty also or restricting too much also. So that is why what RBI came up with grading system, wherein it has graded the scaling system, scaled different NBFCs at different levels and said that these different NBFCs will be regulated in a different manner. That is what scale-based regulation is. Okay, so NBFCs are segregated into 4 different layers based on their size, activity and perceived level of riskiness. Based on their size, activities and perceived level of riskiness. Now, differential regulation is what? You have divided into 4 layers. Now, each layer will have different regulation. Each tier subjected to different regulatory requirements tailored to the size and the risk profile of that particular layer. So, this is what that layer looks like. So, if we start from the base layer, that is the bottom, consists of NBFCs having asset size less than 1000 crore. So, here the size of the asset is less than 1000 crore. Small FCs are there. They may need more hand holding. They may need different kinds of regulations, hence they would be regulated in a different manner. The middle layer will consist of NBFCs having asset size greater than 1000 crores, and here you will have all non-deposit taking NBFCs having asset size greater than 1000 crores and all deposit taking NBFCs. What was here? Consisting of NBFCs asset size less than 1000 crores. So this is the regulation of the lowest layer. Here it is more than 1000 crore. Then comes your upper layer, and then there will be top layer. When it comes to upper layer, you have small set of NBFCs, specific NBFCs which are significant with respect to what? The systemic risk spillovers. Systemic risk spillovers. Remember the concept of too big to fail banks. If they fail, there will be a huge issue because there will be a huge spillover in the economy. So in that way, they are significant with respect to the point of view of systemic risk spillover, therefore required to be subjected to tighter regulation. So upper layer will have tighter regulation. Now, top layer consists of NBFCs that are judged to be extreme in supervisory risk perception, right? These would be pushed to the top. There will be enhanced and more intensive supervisory engagement with these NBFCs. So as we see, here regulation is stricter. Here it would be of the highest order depending upon what the risk perception is for that particular NBFCs. So this layered, this scale based regulation was introduced by the RBI, and subsequent to this there has been resistance that is shown by the NBFCs. Resistance as in they have performed better. They have shown resistance to certain uncalled for negative externalities. They have been resilient to and shown better performance. So let us see how the performance has been. Key highlights: resilient financial landscape. Sector has maintained a double-digit credit growth, meaning the amount of credit that they are giving year on year is having a growth rate in double digit. Okay, adequate capital levels, low delinquency ratio. Low delinquency ratio means low ratio of people defaulting on mortgage loans. Low ratio of people defaulting in mortgage loan is known as the delinquency ratio, and that ratio has been low. And hence, because this is low, credit growth is increasing, delinquency ratio is low. So of course, registered a consistent rise in profitability. At the same time, improved asset quality. What are the assets for an NBFC? The loans and advances they give is the asset because they are going to generate revenue from that. Right? So that becomes your asset. Make sense? Now that asset value quality has increased. The gross non-performing asset ratio has decreased from 4.5 and 10.6 to 2.4 and 6.3 for government and non-government NBFCs. So for both government as well as non-government NBFCs, there has been a decrease in the gross non-performing asset ratio. That means there has been an increase in the quality of the assets. I hope that's clear. Now, what are the concerns? Emerging risks and challenges, especially from cyber security and climate risks. Now, what is cyber security? We'll understand hacking of the system, this, that, threat from cyber security, all that we know. But what about climate? See, with respect to climate, what happens when you are taking loan from NBFCs? You will be taking for something or the other, right? For some activity or the other. Now, climate vagaries can hamper that with respect to any business, specifically agriculture sector, rural development, etc. So climate vagaries, climate risks and cyber security are the emerging challenges in front of these NBFCs, and how to cater that is to be looked forward to in order to ensure that this resilience which RBI has talked about continues to be there, and this there is proper credit growth which is happening right now in double digit, and subsequently profitability is maintained. To ensure that, we have to address these two issues. These two issues can be addressed by better cyber security, by better security, at the same time better climatic awareness, better information dissemination, real-time system in order to take better decision with respect to your business, etc. So that is all about this review article from RBI about the NBFCs. Thank you.